Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Global funds are panic selling, but Trump insists on swallowing Greenland. Financial turbulence meets geopolitical ambition. Is a superstorm coming? 5 clouds are about to erupt, and Gemini 3 will ignite cloud computing. The all-around ecosystem is his confidence to ignore advertising revenue. The software empire returns as king. Under AI empowerment, Microsoft's moat is far deeper than you see. Performance deterioration appears at the start, and rating downgrade fears loom. Can Netflix, the streaming ancestor, still be bought at the bottom? Tonight, we will clarify these matters. Let's start today's program. On Tuesday, U.S. stocks closed down across the board, with large-cap tech stocks performing the worst, led by Nvidia and Tesla. Retail favorites, high-beta stocks, momentum stocks, and the most shorted stocks were sold off. Relatively better sectors included energy, managed care, and consumer staples. In other assets, U.S. Treasuries mostly weakened, and the yield curve steepened. The U.S. dollar index fell 0.8%. Gold closed up 3.7%, hitting a record high. Silver closed up 6.9%. Bitcoin futures fell 6.33%, breaking below the $90,000 mark. Trump's strategy broke the long-term calm. Geopolitical tensions have once again become the market focus. Extreme risks that seemed far away are rapidly approaching center stage with the escalation of the Greenland situation. So, will U.S. stocks collapse this time? According to Bloomberg, as Trump pushes for the acquisition of Greenland again, the U.S. financial market suffered severe turbulence today. The S&P fell more than 2%. The dollar depreciated against most major currencies, and the 30-year U.S. Treasury yield climbed to near 5%. Bloomberg believes this indicates that Trump threatening European allies with new tariffs, superimposed on the crash in the Japanese debt market, is rapidly pushing up market volatility from historical lows. Ian, a portfolio manager at Windsor Capital, pointed out that people may no longer be willing to hold U.S. assets because current investments must include a political risk premium. This makes assets more fragile because politics is different from assets. Its uncertainty is higher. In addition, the market faces a test of the Fed's independence. The Supreme Court will hear arguments on Wednesday about Trump's attempt to fire Fed Governor Lisa Cook. Banks warn that if the ruling allows the firing, it will be seen as a substantial blow to the central bank's independence, thereby triggering further losses in the bond market. On the trading level, Michael Thompson, portfolio manager at Little Harbor Advisors, believes the current double kill in stocks and bonds is a systemic fluctuation, not an individual case. Therefore, it is recommended that investors start establishing hedging positions to manage the downside. Today, Danish pension fund AC Pension also announced that it will clear its holdings of about $100 million in U.S. Treasuries by the end of this month, citing excessive credit risk. But UBS CEO Sergio Ermotti retorted in an interview in Davos, considering the U.S. as the world's strongest economy, it is almost impossible to completely diversify away from investing in the U.S. Yes. Looking back, traders used to deal with geopolitical risks through verbal intervention. However, Jefferies strategist Mohit Kumar speculates that although the tensions over Greenland may eventually be resolved through an agreement, this could take months. During this period, the market will face sustained high volatility. I believe that the sharp market correction today is mainly due to the dual catalysts of the Greenland geopolitical issue and the Japanese bond shock. First is the Greenland issue. Starting with the purchase of Greenland, the Trump administration announced a maximum tariff of 25% on major European countries. The tariff will be implemented at 10% starting February 1st. If no agreement on the transfer of Greenland is reached by June 1st, it will be uniformly raised to 25%, and it was clearly stated that the tariffs will remain in effect until the Greenland acquisition deal is reached. This tough stance quickly triggered market concerns about escalating U.S.-Europe trade friction, causing European stocks to dive during the session, and the euro to fall under pressure against the dollar. Panic spread across oceans, directly suppressing risk appetite in U.S. stocks, leading to a triple kill in U.S. stocks, bonds, and exchange rates. Obviously, this is another manifestation of the collective selling of U.S. assets by the market. However, I think this issue is more of a short-term game, and does not constitute a structural problem. To explain this, one must understand Trump's real purpose. First, Trump intends to obtain strategic resources like rare earths through Greenland to protect national security in military technology and other fields. Second, he hopes to defend against war risks brought by global trends through broader geographic military deployment. So, to achieve these two goals, the U.S. actually does not need to completely control Greenland. At the sovereignty level, but only needs to obtain resource extraction rights and military deployment rights from the Danish government at the transactional level. Conversely, if Trump forcibly pushes for a change in sovereignty, whether facing NATO allies, US citizens, or international public opinion, Trump will encounter great resistance. This doesn't even consider whether Congress agrees, or the uncertainty of whether the Supreme Court rules the tariffs unconstitutional. Therefore, I think the essence of the Greenland issue is still the art of the deal, and it will eventually be handled through negotiation. The US also has a high probability of obtaining a certain degree of compromise. Next is a chain reaction triggered by the Japanese bond sell-off. The cause of the matter is Sani Takaichi reorganizing the Diet. The market predicts that more aggressive fiscal and economic policies will become a high probability event, worrying that Japanese inflation cannot be suppressed, which in turn will trigger a chain reaction of the Bank of Japan continuing to raise interest rates. Corresponding to US stocks, rising Japanese bond yields and interest rates mean a contraction in the scale of yen carry trade, which also means that the cheap capital supporting US stocks may shrink. So with less money, it is not surprising that risk assets fall generally. I think this problem is biased towards the medium term, and constitutes a certain structural problem, but it may be alleviated from other dimensions. Because on one hand, Sani Takaichi's fiscal dominance philosophy started warming up half a year ago. The market had expectations long ago? Now the expectations are deepened, and the probability has become higher, but this is not a new event. Risk asset prices have at least priced it in. Even if Japanese bonds really deteriorate, the Bank of Japan has enough means to deal with the problem, and the Japanese government will likely take some response measures, rather than letting it deteriorate. After all, there was a risk of Japanese bond sell-off in 2024, which also caused panic in the global market at that time. But within 2 days, the Bank of Japan stepped in and solved the problem. Aside from this, on the other hand, the scale of carry trade between the US and other low-interest rate countries is increasing. For example, some institutions have shifted to carry trade sourced from Swiss francs. This firstly weakens the sensitivity of US stocks to Japanese bond yields, and secondly, it deepens US-Europe relations from another dimension, making the Greenland issue more difficult to handle at the sovereignty level. Besides the above two main causes, the market was also disturbed by some other issues, including concerns about the Fed's independence, and the Denmark-England issue leading their sovereign funds to sell US treasuries. In summary, I think in the long run, long-term US Treasury yields will be hard to fall back. The bond market may continue to be volatile, and term premiums will continue to climb, and the crucial 10-year asset anchor will therefore continue to be under pressure. Coupled with the looming AI issues, they will constitute sustained valuation pressure on the stock market. Although there is no need to worry for the time being, attention should always be maintained. In the medium term, Japan's continued increase in loose fiscal policy due to election competition may trigger the next wave of selling Japanese bonds and yen, putting pressure on yen carry trades. However, due to checks and balances from factors, including the election, Fed independence, and other fiat currency substitutes in the medium term, it is currently difficult to judge. However, my personal attitude is still biased towards positive. In the short term, the probability of the Greenland issue being compromised is relatively high, so one should not be overly anxious. The short-term structure of US stocks has not changed either. AI and value are still the main drivers. As for tariffs, I believe this risk should not last long, and will be digested soon. We haven't changed because of today's curve. After understanding the reasons for the big drop, let's look at two investment opportunities. One is Google, favored by Mitao Can News, and the other is Microsoft, which is steady, seasoned, and disciplined. Let's talk about Google first. According to a report by The Information citing internal Google data, Google Cloud's API call volume has shown explosive growth in the past year. Data shows that from 35 billion when Gemini 1.5 was released in March 2025, it has soared all the way to 85 billion in August of the same year, more than doubling in just 5 months. And the Gemini 3 model released last November further fueled this craze. This series of data indicates that the market demand for high-performance models is accelerating. The author of the article believes that Google's key transformation lies in the gold content of the model. Recalling the beginning, Google's early Gemini 1.0 and 1.5 models adopted a deep discount strategy to seize market share, causing their profit margins to be negative at one point. However, with the launch of Gemini 2.5 and subsequent versions, the improvement in model quality has given Google stronger pricing power, allowing it to shift from a pure price war to a quality war. And with this as a catalyst, it achieved increases in both volume and price. Currently, Google has achieved positive marginal profit. This means that every new API call is no longer a financial burden, but a real source of profit. At the enterprise application level, Google is attempting to further expand profit margins through Gemini Enterprise Edition. Current public data shows that Gemini Enterprise Edition has garnered 8 million subscribed users covering 1,500 companies. In addition, there are over 1 million online registered users. However, the article believes that although Google's user base is huge and the growth curve looks very good, user stickiness also faces tests. For example, consulting firm BCG pointed out that Google customer satisfaction with the product is close to 50-50, not super high satisfaction. The article further points out that the volume and price increase of Google models and the 50-50 user satisfaction mean that there is a divergence in the product. This divergence partly stems from Google's unique genes. For example, Google Cloud is more like a builder's cloud rather than a cloud for buying products. This means that many enterprise customers tend to directly use the Gemini model to build their own custom agents, rather than buying Google's pre-made software suites. Although Gemini performs excellently in answering general questions about corporate data, this also makes it appear struggling when handling specific tasks. However, most customers currently still have the patience for trial and error. It can be seen that although the road to monetization at the application layer is bumpy, this has not shaken Google's strategic determination. Instead, it has made it more determined that troops and horses do not move until provisions and fodder go first. So in order to support this race of computing power and algorithms, Google's investment in infrastructure is crazy. The logic behind this is that without the guarantee of power and computing power infrastructure, any growth at the software level will be a castle in the air. Last fall, it was estimated that its capital expenditure in 2025 would be between $91 billion and $93 billion, which is almost double the expenditure of $52.5 billion in 2024. A considerable part of this huge sum of money flowed into the energy sector. For example, Google recently spent $4.75 billion to acquire renewable energy developer Intersect Power at a premium of about 6 times that of its competitors, locking in scarce grid connection rights and key equipment. Through this transaction, Google directly obtained already locked grid connection permits and a development pipeline of up to 8 to 10 gigawatts, enabling it to avoid the years-long grid queuing tide. It is expected to obtain large-scale power supply around 2028. In contrast, the author believes that although competitors like Amazon are also laying out, they are obviously left behind by Google's strategy of exchanging money for time in terms of speed. I believes that the performance of Google Gemini 3 proves that even if the real user experience is not that outstanding, the breakthrough in model performance can still allow the capital market to give a higher valuation. Market worries about AI cannibalizing search ads have also been temporarily put aside, because AI has the potential to open a new growth curve, or even open a new market several times larger than search ads, whether it is through embedded ad subscriptions or API calls. From a more grounded performance level, Google Cloud's performance last quarter greatly exceeded expectations, which started the momentum of Google's growth this time. Combined with the data of API call volume doubling this quarter, I judge that the cloud business this quarter will likely continue the growth trend, and this is the most direct driving force supporting the stock price. In addition, one cannot ignore the shipment volume of TPUs and the extra profit margin brought by bypassing Broadcom in the future. This not only means autonomous and controllable computing power but also represents Google's full-stack cost advantage. Therefore, I think Google's extremely aggressive capital expenditure is not just defensive, but also placing a bet on the upcoming new commercial closed loop. Currently, it seems that this bet was placed correctly on the process and the direction. Microsoft's patience. Next, let's turn our attention to Microsoft. Microsoft's stock price has recently fallen back about 18% from its high in mid-December last year, unable to reclaim the key $500 mark. Is this a relay in the decline or a good opportunity to enter? For investors on the sidelines, this may be the most core game point in current tech stock trading. According to the latest report released by Goldman Sachs, after visiting Microsoft headquarters and having in-depth exchanges with management, analyst Gabriela Borges gave a clear judgment. Among all tech giants, Microsoft is the best target to achieve compound growth using the AI product cycle. And this conclusion is supported by a specific financial path. Goldman Sachs predicts that by 2030, Microsoft's earnings per share will steadily march towards $35. This means it will maintain a compound growth rate of over 20% in the next few years, and the current market panic may be exactly the ticket to enter, because Microsoft is establishing its dominance in the AI era through the flexibility of infrastructure and unique profit margin advantages. So why does Goldman Sachs give such an absolute judgment? The core logic of the research report is that the current AI investment cycle is surprisingly repeating the development path of early cloud computing. Looking back at the early stages of cloud transformation, it was also filled with high costs and weak unit economics. But with scale effects, increased utilization, and optimization of engineering efficiency, profit margins subsequently ushered in a significant rebound. It is worth noting that Microsoft set a medium-term gross margin target during the cloud transformation period, and controlled the actual performance within a 100 basis point deviation from the target every year. This precise execution will repeat in the AI era. Goldman Sachs also cited an example saying that the problem of low computing power efficiency that took 2 or 3 months to solve in the cloud era, the current Microsoft team can deliver optimization in just 1 weekend. Such efficient execution fills the Goldman Sachs team with confidence. In terms of competitive barriers, advantages at the software level are transforming into tangible financial barriers. Goldman Sachs specifically pointed out that Microsoft's partnership with OpenAI gives it a unique gross margin advantage. Because it owns the intellectual property of OpenAI models, Microsoft does not need to pay extra fees when calling these models. This effectively exempts a huge gross margin tax, constituting a competitive advantage relative to other software providers. In addition, Microsoft is redefining the role of large language models as the abstraction layer for the next generation. What does this mean? This is saying that future applications will no longer rely on hard-coded rules but turn to intent-driven execution. This reminds me of Musk's giant application company, and the subversive thinking of AI software. Although the market currently focuses on the absolute cost increase of new models, Microsoft points out that as inference costs decrease, returns will settle more in the foundational layer. In infrastructure construction, Microsoft has shown extremely strong strategic detonation. Microsoft explicitly rejected the bring-your-own-chip model described by Oracle. Management believes this model would discard the scalability and full-stack integration capabilities that the infrastructure layer should have, causing isolation of infrastructure stacks, which will ultimately become the core factor destroying cloud profit margins. This is also the core reason why Microsoft insists on using its own balance sheet to provide customers with a universal chip architecture to maintain the overall efficiency of the system, and is also one of the reasons supporting Microsoft's high profit margins. Furthermore, what gives Microsoft more market advantage is flexible deployment. For example, Microsoft's new server design shortens the cable distance and thereby improves GPU performance. This strategy allows Microsoft to flexibly switch capacity from training tasks to inference tasks, thereby maximizing hardware utilization. Finally, Goldman Sachs places the foothold on the demand side. Goldman Sachs believes that compared to a year ago, the focus of conversations with executives has shifted from discussing ROI to AI and what degree of adoption. The uncertainty about budgets is fading. Customers are no longer holding back budgets to defend against macro risks. Although many customers are currently trying to build AI agents internally, Microsoft believes that as the complexity of maintaining models and building connectors increases over time with compound interest, customers will eventually flow back to Microsoft's platform-based solutions. In terms of pricing, Microsoft has adopted a value-based strategy, short-term broadening adoption through low-price versions, and long-term planning to support higher user pricing. This indicates that Microsoft is shifting from pure sales to deep ecosystem lock-in. Goldman Sachs believes that from existing data and deep research on Microsoft, it can be judged that the attitude of Microsoft's enterprise customers has shown a clear turning point. I believe that compared to Google, Microsoft is slightly inferior in the consumer C-end ecosystem and traffic entrance, but its moat in the enterprise and B-end market is extremely deep, including Microsoft's Dynamics 365, Power BI, and Azure. They have long been core infrastructure in governments and enterprises of major global economies. The number of customers is large, the scope is wide, and the stickiness is extremely high. And the bean happens to be the foothold for AI monetization at this stage. I believe that with the increase in AI adoption rate, Microsoft's B-end advantages will gradually be reflected in performance. Regarding Microsoft's decision to refuse customers bringing their own chips, as interpreted previously with Oracle's financial report, if cloud vendors allow customers to bring their own hardware, wouldn't that be analogous to purely being a plumber providing electricity and rack space? How much premium service can it still provide? So Microsoft's refusal is essentially maintaining the pricing power of infrastructure. Especially in the NVIDIA general-purpose GPU camp, Microsoft's strategy of insisting on full-stack integration has instead become a scarce resource, especially for customers requiring performance and stability. Finally, looking back, why did Microsoft fall during this period? The cause was the earnings report at the end of last October, where Azure business did not significantly exceed expectations, combined with market doubts about AI demand and other macro factors including liquidity. So what about now? Now the sentiment has been alleviated? The voice of AI doubt has also weakened a lot. The demand from the enterprise being has also been confirmed in much data. AI adoption rate will become the driving force for the rebound of tech stocks and other value stocks. Plus Microsoft's financial discipline and research reports from multiple institutions all have solidified Microsoft's performance foundation, making me full of confidence in this giant. Let's wait and see for the Microsoft earnings report to be announced early next month. Netflix's turning point. Finally, let's look at Netflix. Just like last time, Netflix also fell 5% after the earnings announcement. But the difference is that Netflix might really be in trouble. The financial report shows Netflix's revenue this quarter was $12.05 billion, up 18% year-over-year, basically matching the Bloomberg consensus. Adjusted earnings per share were 56 cents, up 31% year-over-year, also basically matching expectations. This is very interesting. I don't know if you remember, last earnings report Netflix's revenue growth greatly exceeded profit growth, and this time it's exactly the opposite. Profit growth is actually higher than revenue. What could be the reason? Management explained that Q4 revenue growth mainly came from member growth, price increases, and increased advertising revenue. In the expense side, this quarter included about $60 million in interest from bridge financing related to the Warner acquisition. Management's explanation did not clearly tell investors why profits grew significantly. If the $60 million financing cost is removed, then the adjusted EPS growth should far exceed the 31% level, exceeding revenue growth to an even greater extent. Since management's explanation was not in place, let's dismantle it together to see what tricks are in the expense side. From the income statement, we can see that costs, sales, R&D, and administrative expenses all rose month on month. Operating profit and pre-tax profit actually both declined. Therefore, they cannot explain the high net profit growth. What really played a role was the tax expense not mentioned by management. It is the key to Netflix's mismatched EPS growth. But there were no specific tax preference policies in the fourth quarter of last year. How did Netflix do it? Since Netflix has not yet published the 10Q/10K filings, we cannot accurately disassemble other long-term debts for judgment. But from the disclosed cash flow statement, we can see that there was nearly $163 million in incremental deferred tax assets this quarter. This may mean that a large amount of deferred tax assets offset part of the income tax expense in the income statement, thereby obtaining higher net profit and EPS. As for the reason, management did not explain, but it is likely related to Brazilian regulations. Specifically, we have to wait for the 10K document to be sure. But what can be judged now is that if the comprehensive tax rate is adjusted to be consistent with the previous quarter, then the adjusted profit should be significantly lower than expected. This is the first reason for Netflix's big drop after hours today. Next, on the cash flow level, Q4 free cash flow was $1.87 billion, significantly exceeding the expected $1.46 billion. This is a positive signal? But at the same time, management also disclosed that due to the acquisition of Warner Bros. Requiring a large amount of financial support, stock repurchases will be suspended for now. Suspending repurchases means the bottom support for the stock price no longer exists. It also means management did not fulfill previous promises, even if this is only temporary. This is the third reason for the big drop after hours today. Regarding guidance, management expects fiscal year 26 revenue to be about $51.2 billion, slightly exceeding expectations. But the forecast of about $11 billion in free cash flow is also lower than the consensus. Overall, it's a mix of good and bad. Finally, regarding debt and the Warner acquisition, management stated, in order to accelerate the shareholder voting timeline and provide greater certainty for asset delivery, we amended the merger agreement with Warner. It is now changed to an all-cash transaction, corresponding to a Warner per-share value of $27.75. At the same time, we obtained an additional $8.2 billion bridge loan commitment. Currently, the total bridge quota has increased to $42.2 billion. But on the debt side, at the end of this quarter, Netflix's total debt was $14.50 billion, and cash and equivalents were $9 billion. This means assuming the final acquisition price is $80 billion, after retaining necessary working capital, Netflix still needs to borrow about $70 to $75 billion. Netflix's net debt will reach $83 billion. Net leverage will exceed 5 times. Therefore, it is very likely to be downgraded 2 notches from S&P's current A grade with stable outlook to B+ with negative outlook. This constitutes greater pressure on valuation. I believe that like Oracle, signs of deterioration in Netflix's fundamentals have appeared. Current cash flow does not support its commercial layout. But the helplessness is that from a longer-term perspective, in order to guarantee their own moat and interests, they have to take this radical step through acquisition or expansion. This indirectly leads to stopping repurchases, borrowing heavily, and even credit rating downgrades. On the bright side, management sacrifice short-term financial health to bet on a higher future curve. On the bad side, if the synergy and income after the Warner acquisition cannot cover the soaring debt costs, then Netflix will fall into a long period of valuation pain. Everyone should remain cautious about this. It is not a short-term event. Next is Bloomberg Top 5. Fifth, Greg, co-founder of Musk's Xe, announced his resignation due to being diagnosed with Lyme disease and will transfer to an informal consultant role to focus on recovery. Yang stated that high-intensity work weakened his immune system, causing the illness to appear. This is another personnel change in the company's senior management following the resignation of two other co-founders last year. Fourth, UAE's G42 company expects to obtain advanced chips from media companies like Nvidia within months to promote it becoming a major global AI participant. Previously, the US had approved chip exports to it. G42 is cooperating with Microsoft and building large-scale data centers in Abu Dhabi. CEO Xiaopeng believes that AI computing power demand is huge, and there is no need to worry about overcapacity. Third, Anthropic CEO warned that selling advanced AI chips to China is a serious national security mistake, even comparing it to selling nuclear weapons to North Korea. Despite this, the US government is relaxing the ban to allow Nvidia to export H200 processors to China. He pointed out that existing chip bans have actually hindered China's AI development process. Second, Snap reached a settlement on a lawsuit alleging that its platform design led to user addiction and mental health problems. The specific amount was not disclosed. This case was originally set as one of the first bellwether trials against social media giants. At the same time, similar lawsuits against TikTok and YouTube have not reached settlements and still face legal challenges. First, Xe applied to the court to block the implementation of a new California law. The law requires AI developers to disclose training data summaries. Xe claimed that the law would force it to share valuable.
Hey viewers, don't forget to like, subscribe, and add our channel to your favorites. We will continue to provide you with more insightful stock analysis.